Hello and welcome. Today, we're tackling one of the most important concepts in financial accounting, the measurement process that ensures financial statements are accurate. To start, let's ask a simple question. If your company provides a service to a client in December but doesn't get paid until January, in which month did you actually earn the money? The answer to that question is the key to understanding accrual basis accounting. Accrual basis accounting means we record revenues when we provide goods and services to customers, and we record expenses when costs are incurred in running the company. The goal is to record these economic events as they occur, not necessarily when cash changes hands. This is the method required by generally accepted accounting principles, or GAAP. The alternative, cash basis accounting, is not allowed for financial reporting for most major companies. The core difference between the two methods is timing. Let's look at some examples from Eagle Soccer Academy. Notice for transaction 7. When Eagle provided training on account, under the accrual basis, they recorded $20,000 in revenue because the service was provided. But under the cash basis, they recorded $0 because no cash was received. Conversely, in transaction 8, when they received cash in advance, the cash basis records $6,000 in revenue, but the accrual basis records $0 in revenue, instead creating a liability called deferred revenue because the service hasn't been provided yet. These timing differences create gaps between what our account balances say and the economic reality at the end of the period. To close these gaps, we need to make adjustments. As you can see, after we record the daily external transactions throughout the year, the next step in the measurement process is to record and post adjusting entries. These are needed because transactions and events have occurred during the period, but have not yet been recorded. All adjusting entries fall into one of two main categories: prepayments, also called deferrals, and accruals. Let's break them down. First, let's look at prepayments, which are cases where cash is paid or received before the expense or revenue is recognized. Our first type is a prepaid expense. This happens when a company pays cash for an asset that it will use in the future, for example, paying for rent in advance or buying supplies. The initial transaction creates an asset. Then, at the end of the period, we need an adjusting entry to decrease the asset and recognize the expense for the portion that has been used up. The other side of prepayments is deferred revenue. This occurs when a company receives cash from customers in advance of providing the services. This creates an obligation or a liability. The initial transaction creates a liability. Then, at the end of the period, as we provide the service, we need an adjusting entry to decrease the liability, and finally, recognize the revenue we've earned. Now for our second category, accruals. This is when cash flows occur after the revenues and expenses are recognized. An accrued expense occurs when a company incurs costs in the current period but won't pay for them until a future period. A classic example is employee salaries. Your employees work the last week of December, so you've incurred that expense in December. The adjusting entry is needed to recognize the expense and create a liability for the amount to be paid. Finally, we have accrued revenues. This happens when a company provides goods or services and therefore has a right to receive cash, but the cash won't be received until a future period. The adjusting entry is needed in the current period to record the asset and account receivable and to recognize the revenue that has been earned. So there you have it, the four types of adjusting entries: prepaid expenses, deferred revenues, accrued expenses, and accrued revenues. While they may seem complex, their purpose is simple: to ensure that we follow the revenue recognition and expense recognition principles. By making these adjustments, we create more accurate and timely financial statements that give a true picture of a company's operations.